I'm becoming increasingly bullish on SoFi beating their Q3 earnings expectations. And if you've been paying attention, there's a ton of evidence in the market that also points to this. Website traffic data, to Google Trends data, to news articles and partnerships that are coming out nearly every week for Galileo. In this video, I'm going to cover them all in depth as to what's making me so confident going into this earnings in 12 days. And I've broken this video into 3 parts. Number 1 is personal loans and the news around that. Student loans is number 2, and then number 3 finally as Galileo. So let's jump into it. And before we go into it, let me just stop and say, if you watch these videos regularly, if you're a SoFi investor, please make sure to share them out, drop a like on the video, follow the channel if you're not following already. I regularly post SoFi specific content and stay up to date with the company. Secondly, let me just also say before we get started that I'm not the only one that's connecting these dots. Earlier today on Wednesday, Tanner made a post on the sentiment change from Earnings Whisper consensus that had recently turned bullish. So Earnings Whisper is basically now expecting -6 cents earnings per share versus -10 cents from Wall Street. In addition, they also raised their revenue expectations from 330 million to 389 million. And I think in large part, analysts are starting to open their eyes as to the possibility of SoFi beating their earnings. I think this is most prevalent in personal loans, so since for the past week, all of the major banks have been reporting earnings. And yes, we've been getting mixed numbers from a lot of them. I'm seeing a bifurcation in terms of the bank's earnings, right? From the investment banks like Morgan Stanley and to the commercial banks like Bank of America or Citi, there are different numbers due to the different types of exposure that they have in terms of how they make their revenue.
Leslie, what is the key thing to watch out of Goldman tomorrow after Morgan Stanley was a miss and some of the other banks like JPM, Wells Fargo, and Bank of America that are tied more to the economy and these higher rates did better?
Yeah, so this quarter, Sarah, to your point, was definitely met with a bifurcation of those banks, JP Morgan, Bank of America, Wells Fargo, far more rate sensitive, Citi also in that camp. And then on the other side, you've got Goldman Sachs and Morgan Stanley, which are much more exposed relative to their peers to investment banking.
So we won't pay attention to the investment banks for now because SoFi overall has less exposure to them. By contrast, we're actually going to focus more on the commercial banks because that's where SoFi's lending segment is most applicable. So basically the thesis here is that by looking at what the banks are reporting on a personal loans segment perspective, we can estimate whether SoFi is going to beat or miss expectations because it speaks to the consumer sentiment in the market as a whole. The major banks such as JP Morgan Chase, Wells Fargo, Citigroup all showed significant increases in profit margins with the federal funds rate, in other words, the interest rate, being at its highest level since 2008, right? We've been raising rates consistently, and this increases the margins, which helps the banks beat their earnings. On the flip side, what this also does is it negatively impacts the demand, since it's going to be more expensive for people to borrow, and as a result, less people are going to be borrowing as a whole. We saw this in many of the banks' earnings with a decrease in transactions volume. As interest rates increase, bank profit margins, including SoFi's personal loan segment profit margins, are also going to increase. However, the flip side of that is that the volume is going to decrease because a rising interest rate environment helps the bank's bottom line. They can use the interest rate increases to expand their margins, and as a result of having expanded margins, all that extra profit just contributes further to their profitability.
Average loans grew at about 12% during the quarter. Bottom line, 81 cents per share in earnings. Again, that was a beat compared to estimates. Net interest income, that's that profitability metric that's been boosted by higher interest rates because it makes for a more lucrative loan-making environment, was up 24% during the quarter.
So in other words, this is good for SoFi's personal loans business because as we discussed last week in the SoFi Weekly Podcast, episode 1, the personal loans business is among their most profitable offerings and definitely their biggest growth product in the lending segment. Here's a clip from last week's weekly podcast.
Personal loans is an insane product for us and no one gives it enough credit. The interest that we receive on average for our personal loans in Q2 of 2022, our most recent quarter, it's 11.62%. That's Crazy. That's the average loan. Whenever we look at student loans, the average was 4.08%. Each individual personal loan is so much more worth, what a student loan is worth. Personal loans in itself is still going to be a product that I'm looking forward to continuing to grow. Obviously, annual default rates and everything like this is also increasing because the interest rates are higher.
Yeah, and keep in mind, just one last thing to piggyback on that. If you look at the last quarter for the lending segment, home loans was down 58%, student loans was down 54%. This is year over year numbers. Personal loans was up 91%. This is origination volume. So total originations was up 9%. In terms of new loans, personal just literally piggybacked the entire loan origination segment and carried it. With personal being the highest profitability offering in that segment, it's just all aggregate positive. And among that clip, there's a ton others. I made a highlight video, which I'll attach in the description. And if you want to catch us live, you can do so this Friday at 10 p.m. Eastern. So now that I've done that plug, and now that we've seen all the banks report earnings, we can now deduce something for SoFi's upcoming earnings. At a high level, we can just assume that the personal loan segment will have good profitability and maybe a higher number than expected of revenue. But the flip side of that is we expect them to take a hit in terms of their growth for that segment. So this growth rate is going to be a key number for me to watch, because at face value, we can just bucket SoFi with the other banks and assume that it's going to be punished. Yes, we will probably see a decrease in terms of what their growth rate is, but not as big as some of the major banks because of the flywheel that happens at the intersection of SoFi's products, which we've talked about many times before. So while I won't blindly claim that SoFi's personal loans segment growth will not take a hit, I'll go out on a limb and I'll argue that it won't take as big of a hit as maybe Bank of America because of all of these other factors in terms of the flywheel effect. However, what we can expect that we now know from the banks reporting their earnings is we can expect higher profitability, and that's just been validated. Now let's jump into the student loan segment. It's definitely been a little bit quieter on student loans. We've seen some upticks in search volume for SoFi student loan related searches. These were aggregated by a Twitter post. I'm going to attach it in the description. But I think much of this was around the same time of Biden's announcement. And so lots of people were searching for that because it was top of everybody's mind. A more recent piece of news, however, came out just yesterday on Wednesday around the Supreme Court, which was asked to block Biden's student debt relief program. It is a request that is being made to the Supreme Court by the Brown County Taxpayers Association in Wisconsin. They directed a request to Justice Barrett, who is responsible for handling emergency application requests from the 7th Circuit U.S. Court of Appeals. Now, even when we initially reported on Biden's announcements, one of the bigger questions that I asked on this channel and that many people were asking on Twitter was simply asking whether the president alone had it in his authority to legally grant such permissions as wide-sweeping as the student loan forgiveness program was. Now, the reason why this is coming up today is because the Biden administration could start processing borrowers' requests for forgiveness as soon as this Sunday. So that program is going to get started very, very shortly. And so now this group has come out and is asking for the Supreme Court to actually block that decision. The request is basically asking that the plan by President Joe Biden to cancel up to $20,000 of student debt for millions of borrowers be suspended pending the outcome of a pending appeal at the lower federal court. So right now, just from reading this, the implication for SoFi, in my opinion, is minimal, since the request is mainly focused on loan forgiveness. And as we've mentioned in previous videos, loan forgiveness will not impact SoFi as much because the average borrower at SoFi is so much higher in terms of their credit score and their average revenue. However, if the conversation somehow escalated to extending the moratorium one more time, this of course could be very negative news for SoFi's student loan segment. Although I think the likelihood of that happening right now is very low, so there should be nothing to worry about as we see it. And finally, on the Galileo front, there was news this week on Tuesday around the partnership between Galileo and Rowe Price on an emergency savings app called Waysaver. The app and the algorithm were both designed by Rowe Price, and Galileo provided its cloud-based digital platform and program management services to power this program. Derek White, Galileo CEO, commented on this partnership stating, "We see enormous opportunities for retirement service providers to strengthen their client relationships with new financial service offerings. Galileo is thrilled to support Rowe Price's innovative savings program WaySaver, and we're confident the program will bring true value to their clients who can now offer an easy way to help their employees save. Now, obviously, this is very positive for Galileo because they're just racking up more and more partnerships every single week. And it's becoming more and more apparent to me, at least, and I think to the rest of the market, that the long-term catalyst to propel SOFI forward is really that technology platform. And I think Galileo, along with Technisys, the entire technology platform segment, is the most misunderstood SOFI product offering has. As I report more and more on SOFI, I've been getting more and more comments around how Galileo and Technisys really play a part into that entire narrative. And I think that a lot of analysts as well are not really pricing in the potential for Galileo to have in terms of their price estimates for SOFI. And I've been thinking about this more in depth recently. I think that Galileo is really the long-term 100x play, the one that will change the paradigm for SOFI. Because right now, SOFI is providing offerings and competing with other fintechs or other legacy providers at face value. That's like at the front end, at the highest level, the consumer-facing side of the business. However, the technology platform in Galileo and Technisys can really have the potential to disrupt the entire game, right? The way that I've been comparing it in my mind is in the form of this analogy. And if this doesn't make sense, please let me know in the comments. But how I'm structuring it right now in my mind is almost in the same way that I see Tesla and full self-driving. Of course, this is a very imperfect analogy, but stick with me for a second. So at face value, SOFI has their own offerings and they compete on like an APY level, on a product offering level with fintechs, with legacy banks. But with Galileo, they also power their competitors on the back end. And by doing so, they collect more on the back end for providing that service. This is similar to Tesla's full self-driving. So Tesla, for example, competes with Ford to sell vehicles. You either buy a Model Y or you buy a Ford whatever. I can't even think of a Ford car right now, a Ford Taurus. This is the face value competition. However, Tesla is the only company that has the full self-driving technology. So basically they have two options. Number one, they can either implement it only in Teslas and leverage that to create a moat around their business. So basically saying that if you buy a Model Y, that comes with full self-driving. Therefore, the value proposition for buying a Tesla over buying a Ford is so much higher, right? You want to buy that because it comes with a unique technology. That's a moat to help only Tesla's business. Or number two is they can license full self-driving to all of these other car manufacturers. And so sticking with this analogy, in a way, SOFI is creating more competition by providing Galileo to other businesses because other businesses, for example, may not have the means or the backend infrastructure to actually build everything out natively in terms of their technology platform. So for example, Riley posted something reminding everybody that SOFI's partnership with Samsung is still very much alive and kicking. Now, Samsung is not really going to go and invest and do everything in-house. They're going to do it through Galileo because it's so easy to use, because it's plug and play, right? And so by having that easy offering through Galileo, SOFI basically created a new competitor in terms of that Samsung fintech offering. They're going to keep doing this through Galileo with many, many, many different competitors. And so SOFI, by providing Galileo's technology to other companies, they're going to be creating new competitors where competitors didn't previously exist. And in keeping with that analogy, this is similar to what Tesla might do by licensing out full self-driving to Ford. So by licensing out that back end, it makes the playing field equal. Everybody on a back end perspective or on a technology stack perspective has an equal fighting chance. And so what that does is it lowers the value proposition for SOFI's products or for Tesla's cars over Ford cars, for example, because now all cars have full self-driving in the same analogy, or all fintechs have Galileo's back-end services. But it also makes it more profitable for that company that is offering that technology, because whatever they might have lost at face value, they're going to gain in an order of multiple in terms of licensing, in terms of all the dollars spent by these businesses that are paying SOFI or that are paying Tesla for full self-driving, right? Because they have a monopoly essentially on that market. And ultimately, they're going to collect a slice of every single one of those dollars that their competitors are earning. So in the same example, let's say SOFI and Samsung, yes, a consumer might, in a theoretical world, be competing as to which credit card they want to get. But it doesn't matter because SOFI is going to collect a slice of that profit regardless of which offering that consumer goes with, right? So like I said, this is an imperfect analogy, but this is how I've been structuring it in my mind in terms of that licensing model, or allowing others to leverage Galileo's technology infrastructure. And we ultimately get, maybe 10 years down the line, a lot of execution risk, but 10 years down the line, or even 5 years down the line, to this whole idea of banking as a service. Since now all of the offerings are very easy to use, since they're all out of the box, it's very easy for other competitors to just hop onto Galileo's infrastructure and create their own fintech offering powered by SOFI. And the reason I bring this up is because of this Rowe Price news. It's because of the Visa Ready partnership that we announced last week. It's because of the DataVisor partnership that we announced maybe 2 weeks ago, 3 weeks ago. All of these contribute to making SOFI's technology platform in Galileo and Technisys a brand name, in promoting that further awareness of this banking as a service paradigm. In other words, they are raising awareness that this is even a possibility, because a lot of the time these consumers don't even know that this is possible. And by doing so, what this does is it further accelerates this AWS of fintech, or this banking as a service paradigm that SOFI is working to make a reality. And so I'll leave it at that for now. And just to wrap up, in this video, we covered the earnings for major banks, how that's a positive for SOFI's upcoming earnings in terms of that increased profitability. We covered student loans, how that's not really going to impact SOFI because it's focusing more on loan forgiveness and less on extending the moratorium. And we also covered news around Galileo's partnership with Rowe Price, and ultimately how that folds into the long-term vision and potential for Galileo. If you have questions, if you think I didn't explain something correctly, or if you didn't agree with my analogy, let me know in the comments below. If you did enjoy this video, please like it, please share it like I mentioned at the beginning. To stay constantly updated with SOFI news and developments going forward, please make sure to follow the channel, and make sure to tune in on Friday at 10 p.m. Eastern for the second episode of the SOFI Weekly Podcast. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.